welcome to another episode of Comp and Coffee. I am super excited to be joined not only by the incomparable and usual Ruth and Bill, but also super excited to have Amy Stewart here today. She's our Associate Director of Content Marketing, but I like to call her the Master of Reports. How you doing today, Amy?
I'm doing really well. Thanks, Russ.
So what is the latest? Well, before we get to work, because I have to ask you, like, are you looking out your window, seeing any form of Christmas-like snow?
Oh, that is a great question. I am located in Seattle, and there is a frosting, I would say, on the landscape for today, which is not, pretty snow, but it qualifies as snow.
Well, that's disappointing. We in New England, we had some snow a few days ago. We had like a half an inch or an inch. It was just enough to be nice, but not ruin the driving. And then we got like 6 inches of rain, and now it's boring. It's wet and just soggy. So, Ruth, how about yourself over there across the pond? Do you guys have a nice snowy winter happening right now?
In the UK, we had snow and freezing temperatures last week, but it's now again got wet and warm. So we're unlikely to have a white Christmas. So.
That's sad. And Bill, you're a little south at the moment, are you?
That's right. I'm in Florida, and it's about 65 and cloudy, and people are complaining about the terrible weather.
They have no right to complain. That sounds lovely right now. It's in the 20s here in New England. So, but anyway, we're not here to talk about the weather as much as that would be. I'm just so excited to have Amy here today because I really want to hear and dive in. We just released a brand new report, the end of year report, which really focuses on what kind of trends we're seeing around jobs and what's happening over the course of the past year. It's been a crazy year, right? Lots happened. Obviously, it seems like you can say that every December of the past 3 years. So I feel like crazy years are becoming normal years, which I feel is weird. But so Amy, give us the summary. Like what is this report? What's the nature of it? And why do we comp nerds like ourselves get so excited to look at it?
Yeah, thanks, Russ. This is called the End of Year Hot Jobs Report. And what we do is we take a look at hot jobs list, meaning jobs that are growing the fastest by salary, as well as by other factors that we can track within our Payscale online salary survey, which is where we get our employee reported data. We've been doing this report for as long as I've been here at Payscale, and I think even before that. And it's always interesting every year, but it's interesting in different ways. As you've mentioned, Russ, it's been quite a tumultuous year, and not the first tumultuous year on top of other years. So this year we looked at the top jobs that are growing by fastest growing wages. And we also looked at jobs where people are leaving those positions. So we have a question in our survey that says, are you looking for another job in the next 6 months? And the jobs in that list are the ones that people are looking to leave the most, based on a variety of factors, which we don't have enough analysis to go into in detail, but we can tell certainly by evaluating the job market at large, kind of what's going on there.
Cool. And this is why I get excited. It's like, wow. So what are moving? What's happening? What are the jobs people are getting excited about and maybe getting paid a little more? What are the jobs are people thinking of leaving? So what? Let's cut right to the headlines. What were some of the top ranked jobs? What are the ones people are looking at going, what are those ones that we should really be keeping an eye on?
Yeah, it is definitely an interesting list this year. In our jobs by fastest growing wages, we're seeing a mix of both blue collar positions and white collar positions. At the very top, we have waiters or waitresses or servers with a salary growth of 30%. Second on the list are private bankers with a salary growth of 25%. And third on the list are media directors with a salary growth of 23%. If you go all the way down the list, you'll see that the lowest percent salary growth is 14%. And I think this is interesting for a number of reasons. We can go into each one if you like, but at a high level, just a broad mix of jobs. But I would say what they have in common, that they are all jobs that have been under either some degree of labor shortage due to a variety of factors, or they are jobs that are seeing increased growth due to changes in the market that are requiring more people of that type.
Wow. Bill, as our compensation ombudsman, who's been doing this probably the longest of anyone here, what's your reaction to that? What does your instinct say about those kinds of jobs and those kind of movements?
I'm going to add one quick, extension to what Amy was just saying, just for the people that aren't looking at the list. When she said it goes down to 14%, that's in the top 20 jobs, like the top 20 highest paid, not all jobs, the worst.
Oh, of course, no.
14%. Yeah, no. Well, just making sure people understand that. But when I look at the list, I see like lots of different things, and Amy touched on this. These are very different jobs as she's reading through the list. Some are white collar, some are blue collar, some are high paid, some are low paid. And I think that the reasons for these high level salary increases are also varying. It's not like these jobs all share the same characteristics that are making them increase from 14 to 30% in a year. Some of them are getting a big boost from changes in minimum wage or changes in what I call effective minimum wage, like what we sometimes on the podcast call the Amazon effect. When Amazon comes into a neighborhood, hourly jobs in the plus or minus $10 an hour range all of a sudden jump up to 15 or near 15. And so, jobs like waiters and waitresses are seeing that effect, is that they have to get paid more to keep them from going to other places. And then you have private bankers who are benefiting from, the sort of counter activity of the wealthy, who, regardless of the economy, the wealthy can spend money, particularly on preserving, protecting, and growing their money. And so private bankers, it's got nothing to do with minimum wage, obviously. It's got a lot to do with the fact that a lot of people have a lot of money and are trying to figure out what to do with it. And then you get sort of media directors and sales consultants, which are companies trying to shift into gear and trying to get back to full steam ahead on making money, on selling their products, on marketing their products. Probably said that in the wrong order. On marketing their products and selling them. And so those jobs are becoming in high demand, and companies are both trying to attract people to fill jobs that either new openings or replacement hires, but also to retain the people that they've already got, because they want to keep things going smoothly with their strong players that they have in place now. So quick interpretation.
I think those are great. And I was looking at I want to ask you, Ruth, I was looking at this earlier and I was kind of surprised by the waiter waitress thing, but you made some interesting observations. What's your reaction to this list, Ruth?
I mean, it's interesting that they have the lowest median pay. So I think their median pay, Amy, in the report was 19,900, I think. But they've got the highest percentage of salary growth, and they actually cross over to last year's list, because I think we had like bartenders or hospitality staff were quite high up in the 2021 report as well. And we know that that's a hangover from COVID. Many people left that profession, and employers are still struggling to fill vacancies in that sector. And they're thinking beyond pay. I mean, not only are they having to pay potentially 30%, wage increases to attract people, but that is obviously coming off a low base. But they're having to look at other ways, like offering super flexible shifts, increasing sign-on bonuses, as well as raising pay, just to try and get people into that sector. But that one probably wasn't a surprise that it was number one. But interesting that it's the lowest paid in that group.
I personally think that the percentage growth is more interesting than the median pay on this job, because how waiters and waitresses are paid, at least in the United States, varies considerably by state. So you do have folks in certain states making as little as $2.13 an hour, and everything else is covered by tips. In other states, you have a higher floor, but the tips might not be as high. So the median pay for that position can be a little bit misleading just by laws that vary by different states for how you put that position.
That's a great observation.
One other thing. Oh, sorry.
Go ahead, Bill.
One other thing in that particular role of what Amy was just talking about is, we also talk about this a fair amount, is Mr. Math, the benefit of a small denominator. Waiters and waitresses that are making, $2.13 an hour, if they get $1.07 a raise, that's 50%. You don't see that kind of like small dollar amount have such a big impact with higher paying jobs.
Yeah, good point. I was curious, and I don't think we have any data around this, Amy, but maybe we do. But do you think some of that could be new legislation that's forcing that some states to require higher base pay for wait staff, which was resulting in that increase?
Other than what Bill mentioned about minimum wage going up in some states where that would apply to waiters and waitresses, and in other states it doesn't, I haven't seen anything specific related to this position in states, but I did not research this position for every state individually, to be candid.
That's okay. I was just curious about that. Well, the other part that this report covers, and I'm really curious about this too, is you mentioned earlier, Amy, that we really kind of talk about a couple things here. One is the highest increases, right? Highest salary growth. But the other thing is, where are incumbents looking to maybe leave? What jobs are people trying to get out of? And what are some of the findings there?
Yeah. So this year, because we are seeing, the continuation of the Great Resignation or the Great Reshuffle, as well as a lot of interest in the term quiet quitting, we took a look at positions where people are saying, hey, I am seeking a new job in the next 6 months. And we ranked those jobs by the percent where that was growing the fastest. So what we see in that list is senior customer service representatives with a salary growth of only 7%, which is, still higher than the average, but they are looking to leave their position at a rate of 19% year over year increase. So I think, if you are a company that is reliant upon customer satisfaction, which I think most companies are, that's a position to keep an eye on. Right below that is software development manager, which I think we've seen a lot of upheaval in the tech market recently. And I do think remote work or the ability to work remote is probably an influencer in that position of folks looking to leave, but that's second on the list. This list is fascinating in a lot of ways. There are more white collar positions in this list than the previous list. And that may speak to the desire of people to continue to work remote, but we don't have a direct correlation to that.
Got it. Interesting. Yeah, there's some really cool numbers in here. Ruth, what's your reaction to this?
Well, I'd pick out a couple of other jobs on that list. I know, Amy, you talk about it in the report of the 2 HR-related jobs there. So human resources assistants and human resources specialists featured at 7 and 10 in that list of roles, kind of most likely to quit from. And I think that's not surprising. It's been a tough year for HR. Life got pretty hard during the pandemic, the rate at which they were having to make change and protect employees, both from a health and safety perspective and a well-being perspective as we've progressed out of the pandemic. So, it's definitely been a tough ride for some of those employees. Is that kind of what your kind of views were on that, Amy?
Yeah, I would agree. HR has definitely been hit by numerous challenges in the last couple of years. I think those particular jobs, HR assistant and HR specialist, tend to be jobs that are lower on the totem pole within the HR occupational set. And I wouldn't be surprised if the desire to leave these jobs is because folks coming into these positions are new graduates or younger in their career path, and they're looking to grow fast. And if they're only seeing, wage increases of 3%, or 5%, they may be saying I can do better if I just take my, 1 to 2 years of experience in this position and leverage that into a job at another company that might give me quite a bit bigger boost than I'm getting by remaining loyal. And I think we see that a lot in jobs where they are kind of lower on the pay band, but are people who are looking to grow faster than the organization may be ready to compensate.
And I think that's what we'll see a lot more of in 23, this focus on career progression and internal mobility kind of upwards in the organization. Because if you think, in the kind of that, what was 30% was the salary growth rate for waiters and waitresses, that's not going to be maintainable going into 2023 for many businesses, particularly because of the economic kind of climate and background that we, is looming or is here already. And so, for employees to get pay increases, focusing on career mobility, moving up the totem pole, as you described it, Amy, is probably going to be the easiest way for them to progress their pay as their expectations potentially stay aligned to the cost of living crisis as well.
Yeah, I would agree with that. I think you're either going to have to do market adjustments for your positions that are higher than your average increases across the board, or you're going to have to be looking to promote people into positions where they're making more money or risk losing them. That's kind of what I see when we look at these numbers. Of course, that will be dependent on what happens in the economy in 2023, which is a whole separate but related conversation.
Big question mark. Oh, I definitely want to talk more about 23 because I think there's a bunch of implications here. But before we do, I definitely also want to get Bill's perspective on these likely to exit numbers here. What does this make you think of, Bill?
Oh, all kinds of things. So, I mean, the interesting thing is that these jobs are, I mean, as Amy said, they're not all white collar or blue collar, but they are heavily leaning toward white collar and sort of low to mid-level jobs, which I find surprising. I think there's, in the top 20 here, there's 2 six-figure jobs, which surprises me. But it doesn't so much surprise me that there aren't many blue-collar jobs, partly because I think, blue-collar people are less likely to say they're thinking about it. And also, I think you have more line of sight to possibilities when you're, say, an HR specialist than you do when you're a dock worker or something. You see like lots of things you can do. And I think I just want to flesh out a little bit of what Amy was saying is like, you can move. I think people are a little concerned about their ability to move up into what you would call the traditional structure. You go from an analyst to an associate to a manager, like HR, but you can also move laterally in your organization or laterally to another organization. So you can change your career path to increase your pay more or increase your skill set. And it is all a function of skills with a lot of these white collar jobs. And we're starting to see more and more people looking at what skills they have and can deploy in a different job or career path versus what title, what name has been placed on them at the early stages of their career, for example, HR specialist. And I think we're going to tie it to the next question. We're going to see like more of that in 2023, more people moving into slightly or very different roles as their next job. I think employers are going to have to start looking at like broader views of where people's careers can move within the organization or risk losing those people to other organizations they've never thought of losing people to.
Yeah, I think that's right. Well, Bill, you kind of hinted at some things, and actually all of you did, hinted at some things we should be thinking about in 23 to react to some of this. And Amy, I love your perspective on this because you comb through so much of our data and putting these reports together. And sort of as we think about going into next year, what's your perspective on the state of the labor market? What do you think? What should comp and HR leaders be thinking about as they go into 23, given some of the insights you've been able to glean going through all this amazing data?
Yeah, we pulled data from the Bureau of Labor Statistics in the creation of this end of year hot jobs report, because what's happening in the economy is relevant to what is happening to individual jobs in our top lists. So I have spent some time looking at that data as well as reading what economists, bankers, other folks are saying about what is going to happen or might happen in 2023 as regards a possible recession. And I have to put invisible quotation marks around possible and recession, because I think that we are seeing a labor market that is, for lack of a better word, weird right now. So, I mean, if you take a look at the report, there is a chart that shows the JOLTS data JOLTS are the job openings and labor turnover data from the Bureau of Labor Statistics. It shows, from before COVID and then up until present, what's been happening statistically around layoffs, hires, job openings, and job quits. And we can see that, during the Great Resignation and the Great Reshuffle, job openings were higher than average, like quite a bit higher than average. And what happened in 2020, early 2020, was everyone laid off their workers because there was all this fear about global supply chains and the inability of businesses to remain open during a pandemic. So they let go a lot of their people. Great Depression levels of people were let go during that time period. And then the economy did a weird thing, and suddenly they had to start hiring people back in order to maintain business operations, especially companies that were trying to shift to some kind of an e-commerce or digital services model. And we've seen that hiring frantically or trying to hire frantically continue for the past 2 years. And although that is dipping in Q4 of 2022, it's still at levels that are above where it was in 2019. So going into 2023, we're still seeing a atypical labor market, which feels like it's still employee driven to a certain extent. Although whether or not recent news of layoffs and a recession changes that we may see that in upcoming job reports, but it's still a little early to say.
What's your reaction to that, Bill? I mean, is that what's your take on the market, and what's your take on a lot of Amy's points?
Amy's brilliant, and I love that she's coined the term "weird economy." I do think that it's very hard to predict what's going to happen here because there's so many conflicting things going on. There's turnover, there's low unemployment, there's the stock market's still doing fine, people are leaving, but there's, low employee engagement. So there's all of this, conflicting things. And I think we're more comfortable when we see everything kind of leaning in one direction or the other, preferably in the direction of, good things happening in the economy. But this idea of things getting better and worse at the same time on, competing metrics is challenging to figure out like what's going to happen. And both of you alluded to things like, these tech layoffs, which are getting a lot of news, but aren't a huge part of the workforce. And, they're not people who are going to be challenged at finding jobs. These are like highly skilled people. They may be, if the economy softens, they may have a hard time getting the same salaries they got at places like, Twitter and Facebook, et cetera. But there's grumblings about that happening in the financial sector, which does have, I think, more of a down market effect, is when, finance people start laying off. That is a sign to everyone else that, you should rethink things. But again, it doesn't mean there will just be layoffs. There will continue to be, even if that happens, layoffs and new hiring. That always happens, and we sort of seem to forget that. We think it's a binary world, and it's not. And so I think that we'll start to see more, and I think maybe understand more as we get into probably late Q1 of 2023. We'll start to see what has happened, what the year-end results for the public companies are, and start getting a sense of whether we're in a recession. I mean, we've been talking about recession for all of 2022.
Yeah.
It hasn't technically happened, and part of the reason it hasn't happened is because even though I think we hit the technical definition of 2 quarters of non-growth, we haven't had the impact that's normally associated with one. And fingers crossed we won't, but it's hard to tell.
I think your wait and see thing is really interesting, Bill, because I'm getting flashbacks to 2020 because every client I talked to back then about, when are you going to rehire or are you going to rehire? They're all like, well, we're going to wait and see what our numbers are at the end of the year because we don't know. I feel like everybody right now is having the same conversation. We're going to have some cautionary layoffs, but then I'm sure after Q1 we're going to know more, and so who can say? It could be another crazy sort of rebound after that.
Yeah, and HR is notoriously, like a late adopter of trends. Because we don't like to increase salaries when the economy is going well for fear that it might turn around, and we don't like to lay people off if we're in a little dip as opposed to the beginning of a downturn. So they HR tends to be a little cautious, a little conservative, and avoid change because change is a disruption, and disruption creates employee relations problems and makes employees uncomfortable.
Yeah.
So I don't think it's surprising.
Russ, if I may, I like what you said, that this feels in some ways like the beginning of 2020, like that same kind of, we're not sure what's going to happen with the economy. And if you make too bold of strokes in layoffs, you might find yourself in a position of being in a, having to rebound and not having the resources to do that, or being in a hyper competitive market with everyone else trying to do the same thing. So I think that is feeding into the caution that organizations are feeling right now around the economy. You did mention about the technical definition of a recession, which does vary by organizational group, but we did have like a slight downturn in the US GDP in quarters 1 and 2, but then it came back in quarter 3, and quarter 4 that news is not in yet. And we've also seen hyperinflation throughout 2021 and 2022, which has been a big news driver over the last year. And part of what we're seeing now with the economy is the Federal Reserve attempting to tame inflation by raising interest rates. And so when we talk about like the housing market and the financial markets being bellwethers for what's going to happen in the economy, the raise on interest rates makes investors cautious because they see that as being, additional expense with a lower return, potentially if the economy does sink as a result of that. So it's like this, trepidatious balancing act between how do we get inflation back down to a reasonable number, and the Federal Reserve has said that they are targeting 2% without tanking the economy into a protracted recession or even depression. And I've seen a lot of conflicting news about what's going on from investment banks, but I think that their view of things is going to be somewhat biased in favor of their own desires for the economy. So I don't know if what they're expecting or what they're saying is going to end up being what actually happens. So it's definitely going to be an interesting year in 2023 for wage and labor market trends.
Yeah. So that's awesome, Amy. And I'm just glad this is all very simple and easy to understand. That's
anyone can just
right. It's so easy to understand what's going to happen. So Ruth, how does this all come together? How do we as HR and comp leaders look at all this, everything that Amy and Bill just highlighted, and how do we put all that together into what we should do for next year?
Well, I think, caution is a great word, and I think we should all, be using that heavily in Q1. I also think right sizing is a good word for what we're about to go through. Maybe that's the better R word than recession, because, things like unemployment, we've had historic lows of unemployment, we've had historic highs of wage growth, we've had, interesting labor shifts. And so I think, maybe what we see happening in the market is not a big kind of panic recession, but it's more a right sizing and maybe coming, slowly back to the new normal. I think if I was in the position of HR, having that conversation with my FD, who was saying, we can't afford to pay wages, you need to start thinking about cutting headcount costs, I would be asking him to think long and hard about how we maintain our talent franchise, because, as you say, we don't know how long this potential recession, even if it's not officially a recession, is. Most of them last about 18 months. I think it's really important, particularly where we are now today in a much more employee-centric world than the last Great Recession that we went through back in 2008 and 9, is that we think more about how we're going to retain employees once we get through next year, because layoffs particularly erode trust. amongst your employee base. So the actions that you take against this quite difficult economic backdrop may have significant implications on you as an employer and your employer brand going forward when the market potentially starts to pick up again.
Yeah, for sure. So it does sound like 2023 is going to be not any easier than any of the prior years. So I'm waiting for one of those easy years. I don't know when we're going to get one. Maybe it's 24. Fingers crossed for 24. Maybe 23 will turn around mid-year. Well, that's what we think about our report. Amy, where can our listeners go if they want to check out this report in more detail and kind of dive a little deeper into it? Where can they go to check this thing out?
So if you go to the payscale.com website, you will see in the top navigation research and insights, and that is the easiest place to go to find new research and insights from Payscale. So the end of year hot jobs report is pinned to the top of that page, and you are welcome to peruse it and send any feedback my way.
Awesome. Well, Amy, thank you so much for joining us today and sharing all these amazing insights and, of course, all the hard work on this report. I for one, and we talk about being data and comp nerds on this show many times. I love pouring through this stuff, so it's super helpful and just fun. Which I was weird, but there we are. So that's what we think about this awesome report from Amy. Have a look yourself and let us know what you think. Jump on over and give us feedback. Either email us at coffee@payscale.com or send us a message on Twitter over at Payscale. And thank you for listening to another episode of Comp and Coffee. Comp and Coffee is a Payscale production dedicated to the compensation community. We welcome your feedback. Send email to coffee@payscale.com, tweet us at Payscale, or share your thoughts in our Payscale Connect community. Until next time, keep your coffee hot and your data fresh.